Okay, welcome back to the chapter 3, part 2 of the recording. So we stop at the type of the current liability. So first of all, I want to introduce accounts payable. So it means that the obligation to the supplies of the merchandise or services purchased on account, right? So it means that you already have the inventory and then you did not pay for it yet. So that's why it's called on account. On account means that no cash involved yet, but there's already essence of the transaction happen, right? And then usually this is become called accounts payable instead of notes payable because the payment is due in 30 or to 60 days. Okay, talk about the devil. Notes payable is a written promise to pay the cash at some future dates and usually requires payment of explicit interest in addition to original obligation amount. So in other words, accounts payable that usually because it's really short period time, it does not usually incur interest expenses. However, notes payable is very long term, so it will involve a formal contract, right, or written promises that it has a specific interest, and also you got to pay for the original obligation as well. And the other kind of current liability I want to say is deferred revenue. And in financial accounting, some of you guys have a hard time to grasp this concept. And what this means that it's representing the cash received from the customer for the goods and services to be provided in the future period, right? So for example, it can be also have another name, this deferred revenue. It can be called unearned revenue, right? So it means that you receive money from people, but you did not providing the goods or services to them. And you were promised to do that in the future period. So this is will become a liability to you, say debit cash and credit deferred revenue. And then say sale of the gift cards, revenue is recognized when the gift card is redeemed or expires. Accrued liability is also sounds really confusing, but it's essentially what it's saying is the salary payable. That's what I said to the financial accounting students. So basically, accrued accounting means that the obligation created when the expenses has been incurred, when you already used the certain expenses, but you didn't pay for it yet, and you will pay until the subsequent reporting period, right? On this, like you owe the salary for, right now it's December 31st, 2020, and then you still owe people salaries. So that owing part is debit the salary expenses, right? And then credit the salary payable, right? Because this payment is gonna happen in the future, but not inside of this period, not by as of December 31st, right? And the normal example is accrued salary payable, accrued interests payable, those adjusting entry we did in the chapter 2, and accrued tax payable. And the third thing that we want to talk about is the current maturity of long-term debt. So we know we have a long-term debt, but the portion of it, so year 1, we borrowed money and it's due in year 20, but we are at year 2, but there's some portion here is due. So the portion is going to be due by year 2 is going to be called a current, and the rest of it going to called a long-term debt, right? So specifically, long-term notes or loans and mortgages, the bond payable that either become a payable within next year or are payable in installments. Those two scenario you will have a transaction needed to be categorized under the current liability section. For example, $1 million notes payable requiring 100,000 in principal payment to be made in each of the next 10 years. So that means that every year you will have a current liability for 100,000 and in the first year, and the rest of 900,000 is going to be categorized as long-term liability. Okay, so let's move on to what is the long-term liability? Long-term liability are obligations that are due to be settled, yeah, right? B, have a contractual right by the borrowing company to be settled in more than 1 year or more than one operating cycle if longer after the balance sheet date. In other words, in human language, it means that the obligation that you owe someone, and you also have the contractual liability to settle in more than 1 year or one operating cycle if operating cycle is longer than 1 year. And this long-term liability have a significant impact on the future cash flow, right? And the long-term solvency that we mentioned earlier is assessed by reporting payments terms, interest rates, and other details in disclosure notes, and this we will talk in details later. So in other words, long-term liability impacting the solvency of the company because it has a significant requirement or commitment from the future cash flow. Examples including notes, bonds, pension, right? Employee has a pension and then they will start withdrawing after they retire, but the employee right now is a 20-year-old or 30-year-old. They are contributing to the pension account, but by the year of 65, they start using it. But during their years of service from 20 to 60, so this whole period they are investing in that account, and hence that account is obligation for the employer to pay employee in when they are old, right? So there's a long-term liability and lease obligation as well, right? You start already using either a property or a capital asset, but you didn't own it. You actually borrowed it from someone, and you owe that person installment payment to compensate the usage rights, right? So those also being considered as a long-term liability. Okay, concept check. So the key distinction between current liability and the long-term liability is A, the amount of obligation to be satisfied, large versus small, no. Long-term versus current versus long-term is related to the length of the time, right? So therefore, I can see C's right here. So the length of the time until obligation is expected to be satisfied. Less than a year versus more than a year, or operating cycle if it's longer. Okay, so now we are in the shareholders equity section. We talk about the balance sheet, asset section with liability section. Now we are at stockholders equity section. So stockholder equity has another name. It's called the owner's equity, right? It's simply the total asset minus liability equals shareholder equity. It's usually have two portions. One is called a paid-in capital, means that externally people funding you, right? And the return earning is internally you generating from net income, right? After you minus the dividend, right? So therefore, they primarily have two sources. One is the paid-in capital from the market, another one is the returned earning from inside. Sometimes shareholders' equity is also being called as net assets, right? Or book value, right? Book value of the firm. And then it includes other equity components such as the accumulated other comprehensive income. We talk about this other comprehensive income related to non-owner gains, right? non-owner related gains or incomes. Yeah, we will talk about it in details later. So shareholder equity, let's say an example. Oh, by the way, let me elaborate a little bit. Other comprehensive income refers to change in stockholder equity other than transactions with owners and other transactions that affect the net income, right? So other comprehensive income is non-owners gains or losses or not related to net income. So if you have some certain income is not generated by the normal course of business and it's not related to the owners, so that means that it's the other comprehensive income. We actually accumulating the items of our other comprehensive income in this AOCI account, just like accumulate each year's net income in the retained earning, right? Okay, so this is an example of Nike, and this is illustration presenting the shareholders equity section, okay, of Nike of 2017 and 2016. Nike has accumulated net income less dividend and of 3,979 and in 2017 and in 2016 it grew to 4,115. And the shareholders equity section of Nike's balance sheet reports the full amount of paid in capital. So these two common stocks and additional paid in capital is called paid in capital in total. Common stock is at the par value, right? And the additional paid in capital is what the price of the stock that was purchased minus the par value, right? The information about the number of shares the company has authorized and how many shares has been issued and outstanding must disclosed either directly in the balance sheet or in the notes. Okay. So now we wanted to emphasize a little bit of difference between the financial reporting standards of the balance sheet between IFRS and GAAP. The first difference is that in the international standard, it specifies a minimum list of items to be presented in the balance sheet. But in the US GAAP, it does not say that you have to present in certain amount of items in the balance sheet. Okay. And the second thing is IAS number 1 revised, changed the title of the balance sheet to statement of the financial positions. So some of you, when you do the financial accounting final project, you say, oh, I cannot find the balance sheet because it has another name called a statement of financial positions. And some US company does use this name. And most interesting part is the third point. The third point saying that the balance sheet of the IFRS often report non-current asset before the current asset. However, the US GAAP always presenting based on the liquidity, right? So we always use current asset, report a current asset before non-current assets, and current liability before non-current liability. Okay, let's look at this question. Which following is true regarding GAAP and IFRS? There are more different than similarity between US GAAP and IFRS. There should be more similarity than differences. Okay. B. IFRS specify a maximum number of items to be reported in balance sheet. No, minimum, right? So not maximum. C. Many company reporting on the IFRS presenting non-current asset before current asset in the balance sheet. Yes, that's the one special thing about the IFRS. And US GAAP specify a minimum. No, US GAAP does not specify a minimum item. Okay. And okay, annual report disclosure. We wanted to look at how does the report, how do we disclose the financial statements? Okay. And the end of each fiscal year, the companies with public interests or public security are required to provide shareholder with annual report. The annual reports including financial statements and additional disclosure. Financial statements such as balance sheet and income statements, a statement of stockholder equity and cash flow statement, right? And also there's a lot of information attached to this financial statement. We call it additional disclosure, and it's including items relating to the business condition, risk factors, legal proceedings, stock performance, and internal control procedures. And then what is a disclosure notes, right? Disclosure notes explain the data that is presented in the financial statement and providing information not directly related to any specific items in the statements. The most important things, for example, are pension plans, long-term debt, income taxes, property, PP&E, lease, and the investment employee benefit plan. All these things are not able to directly reflect in the data of the financial statement, but they are very critical, hence that we need to providing extra information in the notes section that to explain what's going on with those elements or the counts, and hence that it might not directly relate to any specific items in the statement, but is critical, right? And then most important thing is that you have to include a summary of significant accounting policies to describe the description of a subsequent event and related third-party transactions. So what is the significant accounting policies, right? So summary of a significant accounting policies has to convey valuable information about the company's choices from among various alternative accounting methods. For example, management choose to whether to use the accelerated depreciation versus the straight line depreciation, right? Or you want a double declining depreciation, right? Those kind of accounting method has a lot of choices. Or you, in terms of reporting inventory, you use a FIFO, or are you use a LIFO, right? So why are you using this? These are all disclosed under the summary of a significant accounting policy section, right? And or whether you are measure your asset using fair value or historical cost, right? And the company also defines which security it considers as cash equivalent and its policy regarding timing of recognizing revenues and estimated life of their depreciable assets. So it's important to study those notes, these policies, to understanding how the company trading, how the company choose accounting standards to apply among the various alternative methods. And subsequent event is very important as well, okay? What is subsequent event? Subsequent event means that the date of you close the book to the day that you release the financial report. So if you say you release the annual report in February 1st, 2021, and then you close the book of 2020 in December 31st, 2020. So there's a period of your physical end date and the day that you release this financial statement, and whatever happened during this 2 months is called a subsequent event. So subsequent event occurs after a company's fiscal year end, but before the financial statement are issued. And then you need to report the important material subsequent event has a significant impact on the company's stability or operation or financial position, right? For example, during this period, you issue the debt or equities, or you engage in M&A activity, you have a business combination or sale of your business, or you have a sale of big assets, or event that shed light on the outcome of loss contingencies, all those things that you have to report, although your book already closed, right? Annual report is reporting from January to December 31st what happened to this period. But before you report, you release your report in February 1st, 2021. There's say you had the M&A activity happened January 31st of 2021. You have to include in this annual report because these things is very significant, impacting the firm. Okay, so let's go to the next one. Let's take a deeper dive. Okay, and then another thing that you needed to note is called noteworthy transactions, right? Some transactions and events occur only occasionally, but are potentially very important to evaluating company's financial health. And then this category has a 3 category: related party transactions, error and fraud, and illegal acts, right? So related party transaction means that the transaction between the firm and the owners or the management or family of the owners or management affiliated parties, right? You have to fully disclose those kind of transactions. So when the related party occurs, companies needed to disclose the nature of the relationship and provide a description of the transaction, reporting the dollar amount of the transaction and any amounts and the intent of that transaction, right? And also, if your company went through have a fraud going on inside of company, or incur accounting errors, or we call both of them misstatements, right, that are unintentional. When the mistake is made, is unintentional mistake, we call it error. But if it's an intentional mistake, we call it fraud, right? So when your company incur fraud or errors, you need to report that as well. And third, odd things or non-frequent but noteworthy things is illegal acts such as bribe, kickbacks, illegal contribution to political candidates, and other violation of the laws. And then the more frequent of these things happen normally is actually related party transactions. Okay, so concept check. So which of the following would commonly report in the summary of significant accounting policy? Note, error and fraud is called noteworthy events, right? And subsequent events we talk about is the M&A issue, debt or securities. And the method used to record depreciation definitely is dealing with how its company choose over different variety of the accounting choices, right? So B it is. Okay, and then there's a very important section called the management discussion and analysis responsibility, right? In the MD&A section, we short management discussion and analysis section. We are shorting for MD&A. So your management also report MD&A section in the annual report, right? And this section provides management's bias, but informed perspective on significant events, trends, uncertainty pertaining to the operation, liquidity, and capital resources. So in other words, management will write a letter to tell the investors that although it's their own opinion, but it's very informed, very insider information about what their perspective of the future trends and events about the operation, the liquidity of the company, and the capital resources. In management section, MD&A section, and in management responsibility section, and management always asserts that the responsibility of management for the information contained in the annual report, as well as assessments of the internal control procedure. So in other words, management also declare that they are responsible for the numbers that are presenting in the financial statements, and then also the numbers that are generated from financial accounting information system. Those systems internal control procedure are in places and are effective. And also in the management responsibility section, they also require corporate executive to personally certify the financial statements per Sarbanes-Oxley 2002. And this is covered in talk about in financial accounting as well. Okay. And then another interesting thing that we want to talk about is the compensation of a director and the top executive, right? So SEC requires to provide for disclosure on the compensation to directors and executives. So shareholders, employee, politicians, and the public in general sometimes question the huge paycheck received by companies' officials at the same time that more and more rank and file employees are being laid off as a result of a company's cutbacks. So a substantial portion of executive pay often is in form of stock options or restricted stock awards, right? And the executive stock option give the holders the right to buy companies. So stock option means that you have the rights to buy company stocks at a certain price. Usually it's cheaper on the market, regardless of how high the stock's price rises, right? And the restricted stocks is a unit of the stocks was given to the employee, but the unit of stock is not fully transferable until the conditions are met. So for example, there's a contract that gives you 10,000 shares, and then you cannot have this 10,000 shares yet until you make the revenue of the company, say $2 billion, right? So at that time, you can own those shares. So this is called restricted stocks. And because when the company, when the public always kind of question the big checks of executive, while the company still have layoff happening, so therefore there's a proxy statement that must be filed or provided each year to all shareholders, and usually along with their annual report, which is 10K filings, right? Another name of annual report is called 10Ks. And this proxy statement invites the shareholders to annual meetings and to elect board members and to vote on the issues or vote by proxy. And it's including compensation and stock option information for directors and top executives. Okay, so where is the management discussion and analytical located, right? It's located the preceding of the financial statements and the audit report in the annual report. Okay, it's before the financial statement and the audit report. Okay, so now let's look at the auditor's report. So auditor's report is another important component of annual report. And auditors, first of all, what does auditor do? Auditors examine financial statements and its internal control procedure. They attest or they certify the fairness of the financial statements, and they will offer an opinion stated in the auditor's report. And there is a 4 kinds of auditor reports: unqualified with explanatory or emphasized of a paragraph, qualified, and adverse or disclaimer, right? So then what is unqualified auditor report? Usually we call unqualified auditor report means that it's a clean opinion, means that the auditors have undertaken a lot of professional care to ensure that the financial statements are presented in conformity of a GAAP. In human language, it means that this company's financial statement is not free of error, is in compliance with accounting standards. And then you will ask, what do you mean professional care? It's not a hair salon. Okay, the professional care of the auditors meant that they have already done sufficient planning before they conducting the audit, and also they understanding the company's internal control procedures, and also they gathered enough evidence to be able to attest the accuracy of the amount reported in the financial statements. So once they do those fiduciary duties and they find that the financial result is in compliance with GAAP, so they will issue an unqualified opinion. And what is unqualified opinion with explanatory paragraph? And this means that there's the circumstances the auditors believe that the financial statements are in conformity with GAAP, right? However, there is other very important information that we needed to emphasize to the financial statement user. In other words, the book is recorded correctly according to GAAP. But something happened about this firm is not, I cannot let it go. I need to tell people who are using this report. And what kind of situation that I have to notify the people? First of all, it could be lack of consistency, meaning that this year, okay, they play with the GAAP, right? This year they use the FIFO, right? Next year they use LIFO. And this year they use a straight line. Next year they use double declining. So those choices seems always chosen in the benefit of making the net income increases. So this is a lack of consistency will be notified by an auditor to the investors. And going concern. What is going concern? It means the auditors think although the firms has been complying with GAAP, recording everything religiously, however, I have a highly doubt that this company will still exist the next year. Maybe because the competition or industry events or unexpected loss. So the auditors will inform the investors that, hey, this company may not be existing next year. And also, if there's a material misstatement that was made in the financial statement, the auditor will be like, okay, I know it's according to GAAP, but it has a lot of mistakes. I already oversee them to correcting this, but then the mistake is so big that I cannot just keep quiet. Okay. And so therefore, an audit opinion can also include a paragraph that emphasizes a matter. For example, that matter can be, say, the company's revenue recognition, it seems a little bit messy. It's not really fully complying with the new revenue recognition yet. Or it's the company's operating activity is so complex to extend that the conformity of the GAAP is actually in doubt. Okay, and other audit reports. Some audits result in the need to issue other than an unqualified opinion due to exceptions such as, first of all, non-conformity with general accepted accounting principle, or inadequate disclosure, right? Or a limitation or restriction of scope of audit examination. So when in these situations, auditor will issue either a qualified opinion, a diverse opinion, or disclaimer. Okay, so concept check. So I can go a little bit more details in here. So for example, what is qualified opinion? Qualified opinion will be issued either the audit process has been limited. Means that auditors cannot access certain information, and because the company did not allow them to, or there have been a departure from GAAP, but neither of which is sufficient or serious enough to invalidate a financial statement as a whole. So that's when you have qualified opinion. And adverse opinion were given by an auditor when the auditor has specific knowledge that the financial statements or disclosure are seriously misstated or misleading. Adverse opinion are rare because the auditors usually are able to persuade management to rectify, to change the problem to avoid this undesirable report. And disclaimer is usually when auditor is not able to gather sufficient information to do the auditor, right? To judge whether it's in conformity with GAAP. Okay, so now let's see. Which disclosure provide an independent and professional opinion about the fairness of the representation, right, in the financial statements and about the effectiveness of internal control? So A, audit reports. Okay. Now we wanted to talk about how do we use financial statement information. Investors and others are using information that company provide to make their investment decisions, right? Although the financial reports focus primarily on past performance, right, and the present financial position, right? We know that the numbers on the financial statement, such as balance sheets, are using historical recording and in general, or it's describing what is the company's position right now. But the users are most interested in the information about the future. Is the outlook of the companies really good, and that's why I will judge the future. I wanted to use what you're providing me to predict what the future gonna be. Then I can decide whether I want to invest in you, right? Okay. So investors usually want to know two things. First, they wanted to know the likelihood that you will be default or you will fail to pay your obligations, right? So that means the default risk, which is a risk that company won't be able to pay its obligations when it's come to due. Another information that they pay attention is operational risks. It's which relates to how a company can withstand various events and circumstances that might impair its ability to earn profit. So by using current financial information that was creating based on historical information, they wanted to judge the default risks and the operational risk of the company. So therefore, we will learn how to do financial statement analysis, right? So trying to gain a glimpse of the future from past and the present data entails using various tools and techniques to formulate the prediction, right? So this is the goal of a financial statement analysis. If you have a finance major, you are in a finance major, you're gonna learn this as a separate class. And the common method here we're gonna use is first of all, comparative financial statements. Two, that means that financial statements are presented for the preceding year and often 2 years earlier. So you can compare and say 2020 with 2019 and with 2018. See what's the change, right? And I'm sure 2020 is an odd year, right? And then and also you can conducting horizontal analysis means that each item in the financial statement, okay, is presented as a percentage of the base year amount. So this is 2020, and you look at 2019. So if you use 2019 as a base year, so each item, say cash, you look at the cash now minus cash before and dividing cash before, right? And the vertical analysis means that each item is presenting the percentage total. So basically vertical means that you have a total asset here, and each item you compare with how much is the total, right? Yeah. And then the ratio analysis is a financial statement items are converting to ratios, and we will talk details about what kind of ratios matters here. Okay, so which of following describes the risks that a company cannot pay its obligation when it comes to due, right? It should be default risks. Okay. So the first ratio that we're gonna talk about is called a liquidity ratio. Liquidity ratio means that often refers to the ability, right? The ability of a company to convert the asset to cash. We talk about very early in this lecture, to pay its current obligation, right? And we can obtain a general idea of the firm's ability to pay its short-term debts as it comes to due, right? And then common measure of liquidity have two. One is called the current ratio, another called asset test ratio or quick ratio, right? Current ratio equals current asset dividing current liability, and asset test ratio equals quick asset dividing current liability. Current assets are often thought as the most liquid asset of the company, right? And because these assets are easier to convert into cash, and then long-term assets, obviously some current assets are more liquid than the other, and so it is important to evaluate the specific makeup of the current asset. Hence that we wanted to say within the current asset, we will strip off those assets are not that much current, so therefore we are generating another ratio called asset test ratio, and you will see in details. And these two, at least these two ratios, providing an information about a company's ability to pay the short-term obligation. Another important concept we want to talk about is the company's ability to satisfy a short-term obligation is the relationship between the current asset and current liability. And we say the difference between current asset and current liability is called working capital, right? For example, by comparing the company's obligation, right, that will shortly become due with the company's cash and other assets that will shortly be converted to cash or used to generating cash. This analysis offers us insights that what is the ability of the company to pay those short-term debts. Although using the variety of decisions, it is particularly useful to those considering whether to extending the short-term credits, right? So let's look at this example. Nike's working capital in millions is 10,587. This is because the current asset is minus current liability equals working capital. The current asset of $16,061 minus 5,474, then therefore it's getting the working capital of 10,507, Okay, and the current ratio, when we go back to earlier, current ratio is computed by dividing the current assets, right, by the current liability. In Nike, it was reported current asset is a 16,000 and current liability only 5,474. So therefore, current ratio is 2.93. And then, in other words, that this indicated that the company has a $2.93 of current asset to cover each $1 of current liability, right? So for $1 that you owe in the current liability can be paid $2.93 by current asset. Okay. But now we got to be careful, because within this $16,061, there's a portion of it is not that easily to be converting to cash, right? For example, if the like say prepaid rent, right? So prepaid rent, although it's belonging to part of the current asset, but it's not essentially easy to convert into cash, right? So because this problem, that's why we wanted to have a more stringent indication of a company's ability to pay current obligation by calculating a new rate called the quick rate or acid test rate. The only difference here is that the numerator of the current asset numerator is going to be excluding inventory, prepaid rent, prepaid items, and restricted cash. The numerator will only including unrestricted cash, short-term investments, and accounts receivables, right? So therefore, we call it a quick asset. So in Nike's example, the quick asset should only be 9,856 because the inventory is 3,808 and the prepaid expenses are 2,371, and plus the accounts receivable is 3,677. So the quick ratio in this example is $1.80. In other words, for $1 of current assets, a current liability, right? There is a $1.80 of current assets that can immediately transfer to cash to pay for this debt. And then the next question is, are the liquidity ratio adequate, right? So it is generally difficult to say whether some point of the comparisons, right? As indicated previously, common standards for comparison are the industry average comparison to a company, right? Or companies comparing himself with the previous year. And for example, the common standard for comparison is using industry average for similar ratio or ratio of the same company in the prior year. And then the current ratio for industry was 1.43 and asset ratio is 1.15. So therefore, comparing Nike compared to the industry is way better. And the asset ratio, same thing. Nike have a much higher current debt payment ability than the average industry firms. Okay, so which following transactions would increase the company's liquidity ratio? Okay, this is a very interesting question. Okay, so so it's asking which will increase in the liquidity ratio. So liquidity ratio equals current asset dividing current liability. Or current ratio, right? So A, receive cash from customer on accounts receivable. Would this increasing anyone? I thought if you receive cash, then increase in cash, which is increase current asset, it should be, right? You should increase it. However, you are decreasing accounts receivable here, right? Because if I do a journal entry here, you would debit you would debit cash and you credit accounts receivable, right? So basically 1 minus the asset, 1 plus the asset. Hence it should no effect on the liquidity ratio. And second, purchase office supplies with cash, almost the same thing, right? So you would debit office supplies, right? And credit in cash. So same thing, you minus the current asset and you plus another current asset, so there will be no effect on this ratio. And C, pay dividend to the shareholder. So basically you debit dividend and you credit in cash. So basically this will minus current liability, reduce current liability, and reduce the stockholder equity. So it will actually hurt your liquidity ratio. And D, borrow cash by signing a 3-year note. So what you did is you debit cash, right, and you crediting notes payable. So in here you have an increase in current assets and you have an increase in long-term liability, right? So by looking increasing current asset, you should increase in the liquidity, right? So therefore you choose D. The next thing that we're going to look at is a solvency ratio. And solvency ratio is providing some indication of the riskiness of the company with regard of its ability to pay its long-term debt. And the investors and creditors, particularly long-term creditors, are vitally interested in long-term solvency, which is a company's ability to pay its long-term debt, right? And there's the two common financial ratios that we will calculate. One is the debt to equity ratio, one is the time interest earned ratio. Okay, and debt to equity ratio is calculated by dividing the total liability by the stockholders' equity, right? So the times interest earned ratio is calculated as the income before subtracting expenses and taxes, dividing interest expenses. But since we calculated net income after we took out the interest and interest expenses and income expenses, so therefore income taxes, therefore we want to add in the back this two item. In other words, times interest earned ratio, the numerator was supposed to be income before tax and interest, right? But because sometimes we don't know what this number is, so what we happen to do is just using net income, adding back these two expenses. So now let's specifically look at the debt to equity ratio. So the company's resources provided by creditor with resources is basically compares, right? How much resource come from the debt holder, how much resources come from the stockholder, right? So it compares who providing more resources. And this ratio indicates the extent that the reliance on the creditor rather than the owner, because the higher this ratio is, the high leverage of the company. Means that a lot of the resources is coming from debt instead of equity, right? So therefore, this the ratio provides a measure of creditors' protection in event of insolvency, right? With everything holding equal, right? The higher the ratio, the higher bankruptcy risk is. Because the higher this ratio means the more debt this company is owning, right? And therefore the more likely is to fail, have a default risks, and then therefore the higher risks. So let's look at this example. Nike's liability is 10,852 and the stockholder equity is 12,407. So the debt to equity ratio is actually 0.87, right? And the industry average is 0.95 and Nike is actually 0.87. That means the Nike is less risky than the average industry firms, right? Because Nike has less debt to equity ratio. The makeup of the liability is very so more debt here in terms of the industry debt to equity ratio. More debt might increase the potential for the return to the shareholder, but with a higher debt come to the higher risks. This is the fundamental trade-off faced by virtually all the firms when trying to settle on the optimal amount of debt versus equity in the capital structure. Okay, and then let's deep diver look at the times interest earned ratio. It's usually used in conjunction with debt to equity ratio to judge the solvency of the firm, right? This ratio is commonly used. This ratio is calculated as the income before subtracting the expenses, interest expenses, and income taxes. And because we do not have that number listed, so therefore we will use net income adding those two expenses back. To remain solvent or take more debt if needed, a company need to have a funds, right, to pay for those interest expenses gonna be due, right? So therefore, by using the numerator to divide as the net income before the interest expense and the income taxes, dividing the interest expenses, we can sort of see how many times the net income can cover the interest charges, right, is measured by this ratio. And if the income is many times higher than interest expenses, the creditors' interests are more protected, right? And then if the income is barely cover the interest expenses, for this purpose, income should be the amount available to pay for interest, which is you need adding it back. Okay. So if income if income is many times bigger than the interest expenses, the creditors' interests are more protected. And to remain the solvent or to be able to get more debt, right? You have to convincing the creditors that you have the funds to cover the interest charges. So let's look at this example. If it is given that net income is 4,240, and then we have to adding back the interest expenses and taxes and become the numerator, right? And then we dividing the interest expenses of 59. We find that the net income is 83 times higher than the interest expenses in Nike's case. So therefore, they can pay for the interest expenses fairly easy. Okay, so now I wanted to give a little bit explanation on default risks, right? The risk and the profitability. while there are default risks, means that when the debt to equity ratio is really high associated with borrowing, but a company can use those borrowed funds to provide a much greater return to its shareholders, and hence that this refers to as a favorable financial leverage and is very common but risky in business activities, right? So when a company needs money, the alternatives are debt or equity. Sometimes more debt can mean a higher return to shareholder on the condition that the interest expenses is smaller than the rate of return. Okay, so let's look at this example. Okay, so a newly formed corporation is attempting to determine the approximate mix of debt to equity ratio. The initial capitalization goal is 50 million, right? The capitalization mix alternatives has been narrowed to either 10 million borrowing from debt or 40 million in equity. Or second opinion is 30 million in debt or 20 million in equity. The income before interest and taxes is 8 million. The interest rate on the debt is 8%, and the income tax rate is 40%. So calculating net income and return the shareholders' equity for both alternatives. So the first alternative is that income before interest and income expenses is $8 million, right? For both alternatives. The alternative A is borrowing 10 million and then 40 million in equity. Another is borrowing 30 million and then only 20 million in the equity. So the interest expenses, if we borrow 10 million at 8%, so that means that we will pay $800,000 of interest expense. If we borrow, say, 30 million at 8%, that means we will pay $2.4 million of interest expenses, right? So that gives us income before income taxes of 77.2 million, and the alternative is 5.6 million. Hold your horse. You think, oh, okay, this one's better. No, not yet. You will see. So after that, we will pay for tax, right? If the tax is 40% on top of what we earn, so that means that the IRS is going to take away 2.88 million of our income, and on the alternative 2, the IRS is going to take 2.24 million of our pay. And the result net income, yes, the alternative A seems like it's making 4.3 million, and the alternative 2 is 3.3 million. But the return on equity is what I'm trying to tell you. Is the use net income return on equity. Is use the net income dividing the equity, how much the book value of the equity. We know that for alternative A, the equity is $40 million, right? So you use 4.3 divided 40 million, the return rate is 10.8%. Alternative 2 is that you use net income dividing only 20 million of equity. Your rate of return is 16.8%. So in other words, option 2 made more money for the stockholders, right? So we can see that alternative 1 provide a higher net income, but if we will not choose alternative 1, as a return on shareholder equity is much higher, right? If you if you are investors, you will invest in a firm that have a capital structure of option 2 instead of option 1, because the rate of return as a stockholder is much higher for alternative 2. To explain it further, alternative 2 generating a higher rate of return, right? For each dollar invested by shareholder. This is because comparing to the leverage, right, it's $20,000, 20 million equity investment with additional 30 million debt. The cost of additional debt, which if you choose one, if you choose only borrow 10,000, That means when you borrow 30,000, the 20 million extra debt was paying the cost at 8%, right? But is less than return on asset invested, right? How much is the return on asset in this example? Okay, return on asset should equals 16% because you can use $8 million, right? So how do we calculating that? Hold on a sec. Okay, so because you're generating 8 million of net income, and your capital right here, your initial capitalization is 50 million. So therefore, the return on asset is gonna be 16%, right? So net income before the interest expense is 8 million, and then dividing the total asset of 50 million. So therefore, your rate of return on asset is 16%. So when your borrow rate is 8%, which is much less than the rate of return on asset. So that means that you can using leverage to increase the rate of return for the equity holders. Okay. So same thing, let's look at here, okay? So everything is the same, right? A newly formed corporation is attempting to determine a appropriate mix. The initial capitalization is 50, and the capital mixture alternative has been narrowed to 2. Either borrow 10,000 and raising fund from equity holder for 40,000, or borrow $30,000 and the equity holder pitch in $20 million. And the income before interest and the taxes, right now this example say is only 3 million. Okay, so therefore the return on asset is gonna be 3 million dividing 50 is gonna be so let's say 1.8%, right? Wait, it's gonna be 6%, right? So that therefore, so then when you look at this 6%, 6% is less than 8%, right? So return on asset is smaller than the borrowing rate. So that means that the equity, return on equity is going to be negative. It's going to be very small. Okay, right? So how much it is, then let's look at the alternative. So the alternative 1, we will put the return on assets, the numerator, the numerator for 3 million, alternative 1, and the interest expenses is going to be same thing, 800,000 to 2.4 million, and the income before income taxes is going to be 40% of this number is 880,000, and the tax expense is going to be 240 based on this amount, and then the net income going to be 1.3 million, and alternative 2 is going to be 360 million. So alternative 1 have a return on equity for 3.3%, and alternative 2 is only have 1.8%. So in other words, that the return on asset invested had a return of 6%, right, of $50 million of assets, rather than 16% like last time we saw. So therefore, alternative 1 would have provide a better return on equity than the alternative 2, because return on asset has to be bigger than the borrowing rate for investors, for equity holders to enjoy the borrowing benefits, right? The benefits of the borrowing. Okay. So Gensner Inc. has a total asset of 1 million and total liability of 600,000. The industry average debt to equity ratio is 1.2. Calculate Gensner's debt to equity ratio and indicate whether the company's default risk is higher or lower than the average of other companies in the industry. So debt to equity ratio is equals debt. So the total debt of 600,000 and equity is gonna be 400,000 because 1 million minus 600 is the equity, right? So that's equals to 1.5, and 1.5 is bigger than 1.2. So therefore, this company have a higher default risk. Okay, and so therefore C is correct. Okay, so I'm gonna quickly go through the choice of besides talk about the annual report, so we call it the 10K. Right now, I want to introduce you guys another concept that is reporting segment information. So many companies operating in the several business segments as a strategy to achieve growth and to reduce operating risk through diversification. So consider a company that operates in several district business segments, including, say, computer, home, healthcare, textile, computer, and consuming food or food products. The result of these distinct different activities will be aggregated into a single financial report, right? So many different functioning segments of the company has to be aggregated into a single set of financial statements, and it's really difficult for people to figure out which segment is making money, which segment is not, right? To address this problem is trying to facilitate financial statement users to understanding the diversified companies. So we need to, the accounting professions require public company entities to provide supplemental information concerning individual operating segments. Okay, and the supplemental disaggregated data. So basically, you can say textile segment financial statement, right? Instead, also you have to provide in the overall one, but you also in the notes section, you also have to provide a computer segment, computer production segment of financial statement to help a decision maker to understand this overall financial statement better. According to US GAAP, right, we wanted to use a management approach to define what is a reportable operating segment. So this approach is based the way that the management organize the segments within the company for making operating decisions, right? To assessing performance. The segments are therefore evident from the structure of the company's internal organization. The component, right, of the public business entity formally defined as following characteristics. So first of all, engage in business activity from which it may recognize revenue and incur expenses. So if you find that segment can have its individual revenues and expenses, this is one characteristic that it could be a different segment. And then if the operating results are generally reviewed by the entity's chief operating decision maker, so that's another indicator of this segment should be reported separately. And then also for which the discrete financial statement is already available. That's another thing that we can use to judge whether we want to supplement our segment segment financial statement. Mm-hmm. So then if you decided to, if you are required to report a separate or supplement the segment reports, then you should disclose first of all what's this segment's business and what is the operating business of this segment, and the information about the reported segment, either they are profitable or incur losses, and how much is the segment assets. And then also you have to providing a reconciliation of the total segment revenue and reported profits or losses and asset and other items corresponding with the entity's amount, right? And also interim period information as well. So in other words, so business segment information about the Abbott Laboratory, right? So you can see that this is the illustration shows that business segment information reported by them in its annual report. Notice that the business segment disclosure, right? So one is called pharmaceutical, nutritional, diagnostic, and cardiovascular segment. And so the net sales, right, the recognized everything add up together is the total, right? The reconciliation total is $27,000. And then you also can see for each, say, nutritional segment, the net sale is 6,900, and out of that, the operating earnings is 1,589, and there's total asset is 3,160, and depreciation and amortization is 164, and capital expenditure is 147. So all these things are breakdown for segment information that you gotta reconcile all together to look at this number also in the consolidated or the overall financial statement to see whether the overall financial statement have a sales of $27,000, right? Okay. And then there's also another way to report is based on the reporting geographic area. So okay, so this happens when sometimes the companies are difficult to distinguish between the domestic and the foreign companies. For example, most large U.S. firms conduct significant operation in other country in addition to having substantial export sales from this country. So different political and economic environment from country to country make risks and associated rewards sometimes vary greatly among various operation, right, of the single company. For instance, the manufacturing facility in South American country will embroiled in political unrest pose different risks from having a plant in Vermont or in Canada. So without disaggregate the financial information into separate geographic area, right, we can help the investors understanding what is the composition of the overall financial information from the geographic area perspective. So the US GAAP actually requires reporting certain geographic information, such as the revenue from external customers. You have to separate it domestically and attribute it to foreign customers, and the long-lived assets or long-term customer relationship and other policies, whether it's domestically and how much is attributed to foreign countries, right? Okay. And another thing important is about how do you report major customers, right? So financial analysts are extremely interested in the information concerning the extent, right, to which a company's prosperity is tied up in one or more major customers. If 10% or more of revenue of an entity is derived from transaction within a single customer, the entity must disclose the fact that these facts to the outsider, because it's quite risky, because one of your customer is leaving you, right? This major customer is leaving you, you're gonna lose at least 10% of your revenue. That's scary. So therefore, the company need to disclose that along with information about the total amount of revenue from each such client, and also identify the operating segment and the segment reporting of the revenue. And then in international financial standards regarding the segment reporting, US requires the companies to report information about reported segment profit and losses, including certain revenue and expenses, segment asset, and basis of measurement. And IFRS requires companies also, on top of that, also disclose total liability and reportable segment in additional to US items requirement. Okay. So I just want to do a quick summary of chapter 3. Chapter 3 is a focus on the balance sheet, right? And we're starting with the asset side, and we detailed introduce the concept of current assets and long-term assets, right? And then we talk about the liability. Also, based on the liquidity, we separate the current liability and long-term liability. And on the equity section, we kind of touched on the paid-in capital, right? And we talk about the returned earnings, right? Okay. And then we move on to the disclosure, right? The first thing we introduce is disclosure of 10K. What that means, that it means not only you have to present in financial statements, which is a balance sheet, income statements, statement of cash flow, and a statement of stockholder equity. At the same time, you have to have notes, right? In the notes section, you got to have a summary of significant accounting principles, right? That gives people understanding of what the choices you made and why you choose that. And second thing that you need to supply the notes, notes section, supply the notes to explain certain amounts inside of this report, or declare explain important treatment of the company. And then also you have to have MD&A section, which is the preceding to which is at the beginning of the 10K, to describe the risks and management understanding of future risk and the earnings potentials, right? Okay, so this is basically the disclosure section of this chapter. And also then we are moving on to the second segment, means how do we use balance sheet to predict the future prosperity of the company, right? So and then we discussed there's a liquidity ratio, which is see whether the company can use the current asset transfer to cash to pay for current liability, right? And there's a current ratio and there's an asset ratio. And then we look at a solvency ratio. So basically this ratio tying to the bankruptcy risks, right? And then it's first of all, it's equals to debt to equity, or you can use times income times ratio times income ratio, right? So times interest expenses ratio, right? This is a look at first of all, what is how much proportion of the resources coming from debt owner versus equity owner. The higher this one is, the debt owner gonna be less protected, right? Because a lot of the money gonna goes to a lot of debt holder, and each debt holder gonna have a less likelihood to claim any assets when it's a bankruptcy. And the times of interest expense ratio means that how much the net income can cover the interest expenses, right, when it's come to due. And after that, we also discussed what is the return on asset relationship with borrowing rate, right, and why the default risk actually can multiply, or can be a multiplier for the profit, for the stockholder equities, right? Return on equities. We say that when the return on asset is higher than the borrowing rate, so that means that the stockholder equity can use the borrowing as a leverage to increasing the return, right? So after this, we kind of touched miscellaneously about the auditor's roles, right, and the auditor's reports, and then also segment reporting standards, so on and so forth. So majorly, I want you to get an idea about what is the balance sheet, and what is the capturing, and what is the sub-classification, and what is the annual report, and what is the notes, most important notes, right? And how does the investors using balance sheet to assess the liquidity risk and the solvency risks, and why why leverage, why borrowing and the profitability is hand in hand, right? Why borrowing can increase the profit for the equity holders, right? And then and the other miscellaneous item. I know this recording is a little bit long, but I just want to get into the everything in there. Too many pieces will be discouraging, so you can pause when you watch it, or you can just do all the way. Okay, so thank you for listening, and thank you for watching this video. I hope it helps you learn chapter 3, and I will see you in chapter 4.